All right, with the market starting the week strong on hopes of a trade truce over the weekend, we certainly finished in the opposite direction with a 60-point loss today on the S&P 500, down over 2%, down 4.5% for the week, even after incorporating the gain that we had at the open. So what does that mean now? We've been at these levels before. We've been at these levels before recently. What do we expect to see this time? Now that we're here again. And how different is it now in terms of other technical patterns than it was those last couple of times? So I'm going to break all that down with a trade idea on a stock that's made an extreme move to the downside across multiple indicators, and how can we take advantage of that? So let's go ahead and get started. Today is Friday, December the 7th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. And you can see how we finished at pretty much at the low of the week here this week at yesterday's low point at that long lower shadow. So the long lower shadow is low, still holding as a support on the closing basis. But you can see we closed the Friday after Thanksgiving at 2632.56. We closed about 50 cents higher than that today. So we're right there at the lows. And this low point in October, at the end of October, was 26.41 after hitting 26.03 on a low basis. So that long lower shadow on the weekly chart still holding for support, but trading obviously within the range of that week easily here a couple of times in the last couple of weeks. So we have a bearish posture with the intermediate line down and close to crossing below 50. When it crosses back below 50, that's when it turns dark pink again, and that's when you're, with the red line here turning red. That's the concern, right? Because again, the expectation is 1 to 3 months once it crosses above 50, and you had a pretty decent cross. It wasn't like a couple of times here. Well, we had this cross, we got a little bit better before turning down, retesting the low. And then again here, this was more of a cross like we had recently, where you just barely get above 50 and then pull down. So we're getting a similar cross here now to what we had in February and early March, where you did get a little bit higher, but still considering that we are about a month, 2 months into this little decline here. This bearish long-term run with the market sentiment falling, that's a concern that we're not, that this intermediate posture wasn't able to take and go that expected 1 to 3 months. Now, of course, again, as I mentioned before, this is all noise until one of two things happens, right? Until we break through 2600 or until you break through 2800. It's going to be very, very noisy. The bears will be the noisiest here and here and here, and the bulls will be noisier here and here and here, right? That's what noise is when everybody's saying how doom and gloomy we are, and then how much we're going to be heading to the upside. So until you break through 2800, these highs, until you break through these lows on the downside, we're going to have noise, and the moves are going to be bigger simply because of where volatility is right now. We're not talking about volatility in the low teens. We're looking at volatility in the high teens at the low end, and the low 20s at the high end. So that's why we're getting such bigger moves. Plus, these moves to the upside and to the downside are both are headline driven, right? They're driven by expectations of what trade, the trade fears, trade tariff fears, and how that can impact economic indicators. So you notice though the near-term line, when you do get bearish, strongly bearish, that near-term line will drop into the reversal zone, and we don't have that yet. Now, it doesn't mean it can't happen eventually, but we don't have that yet. The momentum line's falling. Didn't fall below the 5th percentile, what it did over here. But again, you're going to get bigger momentum line moves, and that's going to be more volatile when the VIX is as high as it is. Again, when you get an extreme momentum line move, when the VIX is really low, like low teens, that's more significant than an extreme move in the momentum line when the VIX is at 20 or higher. So you're going to get bigger moves, but still your momentum line falling significantly, and you can see a little bit of divergence. We don't really put a lot of stock into that divergence, but you can obviously see a much lower low, even if the momentum line didn't form a lower low. But it's that near-term line that kind of stands out. It's that long lower shadow from yesterday that's kept it from dropping into the reversal zone. So that long lower shadow still acting as a bullish sign, even if today we came down and retested the low point of that long lower shadow and traded within the range. Of course, whether we hold that is most likely going to coincide with whether we hold 2600. Right, because that's a key level that we tested here on an intraday basis, and even over here we did go down below it a few times. Went to 2532 in early February, and then we went down to 2581 here again in early April. So when I say 2600, we're obviously talking about a zone around that area, and that zone was established earlier this year, and now we're testing it again later this year. So the posture is bearish, but that bearish run doesn't start until you cross back below 50. That's when the dark pink shading. So when are the kind of long-term bullish expectations going to turn into more long-term bearish expectations? That this noise to the downside will turn into more of a trend now, besides just this pullback. This kind of long-term pullback to what would be an equal market sentiment low point. You can see when you look at the lows and the highs in the market sentiment line, here's the last low point on the market sentiment pullback. So we're actually slightly higher, but we're retesting. We haven't broken below long-term lows, and that's when the narrative changes completely. That's when you're in a bear market, is when you start getting new long-term low points, or even this intermediate lows. You can see we do have a lower intermediate low. There's the last intermediate low point. Here's this is the lower intermediate, coming down from a higher intermediate high down to a lower intermediate low point. Then here's a lower intermediate high and a slightly lower intermediate low point, at least on a closing basis. Here's a slightly lower intermediate high point. Again, we did get up to 2800 plus and on the futures, on the overnight trading there. So similar touches in this area still, even if on the cash index we got a slightly lower high. And then again, if the intermediate line crosses below 50, we'd be at the same intermediate low point. So you can kind of see the sideways trend that we're forming right now in these intermediate highs and lows, and the equal low we're forming, and why things change if we break down through this 2600 area with a bearish posture, not getting the expected 1 to 3 month run, not getting the intermediate line up above 80 like you typically do when you get a bullish intermediate run going, and breaking and having that red line, that 6-week moving average being red. So that's when things change. Until then, we're in a noisy market. We were really noisy here, and the market's rallied. We were really noisy here. The market was going to end, right? The futures were going to tank, and the markets were going to be in a bear market mode. But that didn't, we didn't. So we're noisy, really noisy again. But don't get caught up in the noise. Make sure that if you are going to turn your portfolio into a bear market portfolio, that you do that when the charts tell you that we are now heading into bear market mode, and that would be when you break through 2600 and the intermediate line breaks down, you break to a lower market sentiment low point, and that red line stays bearish, right? Until then, we'll see Monday if we get the same reaction to this level that we did the last two times, right? We got a move from 26, we got to move from here up to 2800 in the matter of a week last time, and we got to move from here up to 2800 in a little bit more than a week the time before that. So we'll see if we get the similar reaction on Monday to a level that we've bounced off of a couple of times before already. From a long-term perspective, you can see how volatile we've been around the 200-day moving average. This isn't the first week we've closed below it. In fact, it's probably well, we closed a smidgen below it right there. So this would be the fourth week we've closed. And fifth week we've closed around it. You can see, we've closed below it here, right at it there, right at it there, close below it here, pretty much right at it there, and close below it there. So we're like 6 weeks. We've been trading around this 200-day moving average. We haven't, every time we've broken below it, we've bounced right back up above it the last few times. So we'll see if that a pattern follows again next week again. You can see we got the cross of the 50-day moving average down here at the bottom, crossing below the 200-day moving average. Again, last time we had that was back here, and you can see that set the low point that we eventually bounced off of a few weeks later. We got another cross in 2016. We set the low a couple weeks later on that before rallying here. So the death cross didn't lead to recessions or bear markets in the stock market either these times. And again, the difference here is we haven't had the convergence in the MACD. We've had a sharp drop here, and usually the sharper drops lead to bigger bounces to the upside. Again, that expectation changes if you break below these lows that we just haven't yet. But until then, you expect, based on what we've seen in the past, big sharp drops from strong MACDs tend to bounce up. It's these declines. In fact, let's go back to 2008, 2007. I have to go a little bit further now. I have to go past a 10-year chart. That's crazy that we have to do that. But you can see how we had a more of a steady decline that started in, what would that be, June of 07, where the MACD hit its peak on a long-term basis, and we didn't get the crossover until 6 months later. And so again, here's the peak here that we're coming down from in September, and it's been a few months that we get the crossover. So about half the time, a little bit, a third of the time that we got the crossover. So a little bit, we didn't quite get the same grind. And you can see even over here, let's see if I can zoom in on that area in 2007, 2008. Here, let's go to 06, 30 in 2008, and then we'll go 2007 here. Actually, I had to go back a little bit further, don't I? So let's do. Let's go back to 2003 and go to a weekly chart. There we go. So here's what 2007 looked like. And again, we got that low point immediately after the death cross that we made the return move back to the 200-day moving average. Not getting above it and staying above it, that's when the bear market really started. So you get the death crosses. It usually sets a low that can be retested. But then you make the return move. And we saw in 15 and 16 that return move got you going again on a new bullish run. But in 2008, you remember the stock market peaked in late 2007. We had the inverted yield curve in 2005. The Fed stopped raising rates in June, middle of June of 2006. So it kind of gives you a timeline of when we had the death cross there. That started the bear market. It occurred well after the Fed's interest rate hike cycle during that time frame. And so anyway, so now we go back to where we are now, and we say, okay, again, the expected pattern here, especially with the death cross, is to set the low point, maybe another week. But again, if we hold this 2600 level, then we expect to bounce. If you break through 2600, then things change, right? Then things change significantly for a lot of these stocks. And if I were to go back to, a linear regression trend line for the S&P 500, it's not like we're at extremely high levels now. We are at extreme low levels as it is. So there's the 1-year chart. Now, if I look back at we'll go to longer time frames, there's a 3-year chart. So we are outside the 2 standard deviation on a 3-year chart on the S&P 500. And then finally, looking at a 5-year, you can see we are not. So, that's a little bit more significant here, that we still got we can turn this, if we break 2600, we can head down on a long-term basis, which is what happened. If I were to go here, let's go back to the 5-year chart for up to 2016. Let's go to February the 8th of 2016 to see what that looked like. February the 8th of 2016, and we'll go 5 years before that, February the 9th of 2011. All right, so here's the 5-year linear regression for 2016. You can see we did get below. So that's the difference now between 2016. We were below the 5-year, the second standard deviation. That's how significant that pullback was and why we rallied so much out of it. All right, so let's take a quick look at the 3 green arrow charts. And you can see obviously 3 red arrows again. And we're back below after getting above all these moving averages, and the 8 and 17 day crossing the 30 here. We're right back below it, so the 8 and 17 right back below. But we can see that our MACD, when we hit this low point, how low the MACD was, which is the gap between the 8 and 17 day moving averages. Then the next time we touched this area, it was a much higher low point, and then now we're touching this area again, and it's a much higher low point, so far at least, on the MACD. So you can see we're still in convergence mode on the MACD, converging to the upside, right? Converging from these extreme low levels to the upside. Stochastics down back below its moving average, again similar to the intermediate line on the market forecast. Here's the intraday chart, and you can see, again, we didn't get a lower low point because yesterday's low point 262.44, but we are trading right at the 4-week low. You can see this morning hitting that confluence of lines here, 200-day moving average, the 4-week midpoint, the Heikin-Ashi Open, a lot of different levels in this midpoint area that we hit on the way back up, and now we're testing this low point again on the 4-week basis, well off of the 4-week high point. And again, we only have an 18-point move, so this isn't extreme. The extreme 4-week range was earlier in February. That's when we had the extreme in the volatility index as well. So we're retesting this low point as of right now, and we'll see. We did get a higher weekly high. So this week's high on Monday was much higher. The low point this week was lower than last week's low point, retesting slightly lower than the week before's low. So it was kind of an outside day here at the bottom end of this kind of this weekly move. This outside day, we'll see if that turned into a reversal pattern or not, having that outside not outside day, outside week on the weekly chart. And you take a look at the volume for today. And the trading range. So we'll just take a look at this here. So no significant gap here. The range today at 8.5 points. The volume though 160 million. So less volume today than what we had on the last couple of days on here. And you put that in the context, 160 million in the 8.5 point range. 8.5 point range is well above the average. So the ATR is jumping up again. The ATR here is still at the 2% mark. Remember, the significant moves that start bear markets, as I showed you before, get the ATR ratio up to 3% or 2.5 to 3%. We haven't gotten above 2% yet on this. The ATR is still right around, again, 3%. You're looking at, at 5.2 plus another 2.6, so you're looking at about a 7.8 ATR that we're not to yet. And the ATR is the average range over 14 periods. We did have an 8.5 point range today. The average needs to get to about 8.5 points for us to say, okay, this move is, we'll get a return move, most likely the 200-day moving average, but that move is what started the bear market. And we don't have that quite yet in terms of the size of the pullback here, and on a relative basis. Again, you get these ATRs up to 5, 6 points. that's a big deal when the S&P 500 here. Let's go back really quick. All right, so if I look at SPY, let's go to a daily chart here. Look at the daily ATR. Okay, so when the S&P 500 is down, say at 100, and this would be in 2011, we were at the ATR was at 3. So that's a significant move on when the price itself is near 100 on SPY. That's why the ATR up here, and that's why 2011 was so significant, because we did have the beginnings of a bear market absent this Operation Twist in QE3 that helped us avoid kind of this double dip recession, so to speak. We were significantly bearish there, as you see. But now, the ATR is at 5, but the SPY is at 263 versus 100 in 2011. So, the ATRs are naturally going to get bigger. That's an absolute value, whereas this up here is a relative value. And when you look at absolute values, you have to remind yourselves that we're going to get bigger moves in terms of point values on the S&P 500, the Dow Jones Industrial Average, because the indexes themselves are at higher levels. The ATR is naturally going to get bigger, and that's the point of having this ATR to price ratio, because that keeps it on an apples-to-apples basis across long time frames. All right, now looking at the volatility index, you can see so we jumped down here to a lower low today than what we saw a couple of days ago when we had the volatility surge. So here's that volatility surge coming out of the day off on Wednesday, the day of remembrance there. Then the volatility index dropped as we rallied to the close yesterday. And then today, retesting the low point on the S&P, we did not retest the high point. So you can see the high on volatility today did not get up to above this extreme level like we did at the open yesterday. So an interesting little development there in volatility would suggest that we're not as bearish as even we were. And at least the options market is not as bearish as it was at the open on Thursday heading into the weekend. Alright, again, the camera's not working here, so we'll just leave this chart up as I summarize the market posture. We are at this important inflection point around 2600. The expectation is that we'll come off of it like we have before. The last two times when things really got noisy to the downside, we made sharp moves up to the upside. Now, granted, those sharp moves up to the upside were led by positive headlines, so whether or not we get positive headlines next week or the week after to get us there again obviously remains to be seen, or whether negative headlines produce a move down to 2600, which again is what's the problem, right? The issues that we're having. Economic numbers are still relatively strong, as we saw the ISM services earlier this week getting above 60 2 months in a row for the first time ever. So you've got relatively strong. The employment numbers you'll see here in a second wasn't as strong, but it is headlines that have driven us to the downside, and it's headlines that have made the moves to the upside in the last couple of bounces, and we'll see if that's the case again. Of course, things change from a long-term perspective, expectations perspective, if we break through that 2600 here, and we'll keep a close eye on that as we did the week after, or the week of Thanksgiving, and the week they're heading into Halloween. Last couple of times that we were at these levels. So what do you think about that posture? There's a link popping out in the top right corner of your screen. Click that link, then either hit agree or disagree. If you click on disagree, scroll down to the bottom in the comment section. Love to hear on a crazy week like we've had. Would love to hear your comments on what you're seeing that tells you that there's a really good chance we break through that 2600. What patterns or what other indicators that are telling you that we are due for that breakdown. You can share that with the Market Scholars community in the comment section below. All right, if you take a look at what's driving the price action and look at this week and how bearish we were this week with a 4.5% drop here in the S&P 500, the small cap stocks down 5.5% after starting the week strong, up over 1% at the open on Monday. But then, of course, falling as much as we have you can see what's, all these equity asset classes to the downside. Crude oil actually bounced up. As bearish as we were on crude oil bounced up 3.5% this week, coming off of highs at one time on Friday or earlier today, up 6%. And you can see bonds had a strong week, up 2.5%, coming down from their highs on Thursday, and gold at a 3-month high now. Gold continuing to make a run, kind of showing you the bearish sentiment that we have on the U.S. dollar. And usually the bearish U.S. dollar has a bullish impact on emerging markets and international stocks, and you can see they've outperformed this week. They're down 3%, but outperforming U.S. stocks. And interestingly enough, here DBA being the agricultural commodities, they're kind of a reflection of the market's expectations for this trade truce or trade battle war that we have going on, at least from our end of things and what we export over to China. And they actually were up today and finished the week higher on the week. Starting the week strong because of the news that came out over the weekend in terms of a potential trade truce, and then finishing the week strong. So kind of a reflection there of what the market expects between the U.S. and China, even if the stock market, which is obviously a lot more fickle, dropping down, expecting worst case scenario, of course, heading into the weekend where the market's closed for a couple of days. Of course, the biggest news out today was the jobs number coming in below expectations. The unemployment rate staying at 3.7%. You can see the participation rate rising. That has an impact on actually raising the unemployment rate. The participation rate rising there. Average hourly earnings staying relatively strong, but not up, down a smidgen below where we were, and then our average work week dropping down a little bit as well, just a smidgen. When you take a look at that year-over-year growth rate in the jobs numbers, we are pulling back a little bit over the last couple of months after rallying through most of 2018, starting to pull back a little bit. You can see the total numbers here on the left-hand scale. So not as low as we were a couple of months ago, but you can see kind of lower end of this year. When this year's peaks and valleys, we're at a lower end of the valley of what we've seen over the past year. When you take a look at that versus expectations, obviously being below expectations bring this line down. But you notice we're not dropping significantly down like even we did in the middle of 2017 on these economic indicators. We're staying right around zero, which means the results over the past few months are a little bit below estimates as a whole, but not significantly below like we've seen in prior years. And obviously we've been a lot more bearish in these foreign indicators than we have in the U.S. What that's done is it served to bring expectations for a rate hike down. Now, initially on Thursday, this number did get down at its worst, down to 66%, after being at over 80% just a week ago, and that's for a rate hike in December. So it'll be interesting to see whether we still get that rate hike. We're still most likely going to get it, but that not as likely as it's been in the past. The odds of a rate hike in March have dropped significantly. I mean, we're down to basically 25% odds. So the most likely scenario the market's pricing in is we get one more hike in December, and then the Fed's done at that point. And we'll see if that's how the language plays out here later this month. You can see economic indicators being updated today, still about 2.4%, so down from where they were from 2.7%, still above 2%, and still above inflation levels, of course. Again, that's we've seen this number even in the most recent past being well below, closer to zero, and the fact that we're still, in fact, here's the more recent history for those numbers, and you can see, we're still at 2%, and we've had a couple of those there in at the end of 2017. We've been below 2%. In fact, in 2015, at the end of the year when we had the death cross in the S&P 500, we had a couple of quarters of below 1% growth, and we were close to zero here. In fact, that was revised upwards to get to 0.4%, and you can see how we bounce back in the first quarter. So as bearish as we are now and having a death cross in the markets, our economic growth expectations are not that low now. Now that doesn't mean that we won't be that low. These are just estimates. But it's interesting to see that as doom and gloomy as we are, it's mainly just a sentiment doom and gloom. It's not necessarily the reflection of a weakening economy here. Of course, when I say a weakening economy, the economy has been stronger, and we're not going to get these strong numbers obviously here. But you can see in these couple of quarters and how bullish the market was in 2007, that's the type of numbers that we're expected to get the next quarter. So a little bit of a divergence here between economic reality and what the stock market is pricing in terms of sentiment. Alright, when you look at how the sectors are performing, we'll come over here and pull up their weekly returns. You can see that over the past week, your best performers here have been the utility sector. They were actually up this week in the real estate market. And you can see Staples. These are safe haven areas. Energy outpacing the market, as well as discretionary communication services outpacing a little bit over the market. The biggest loser this week, with the yield curve falling, is the financial sector. Industrials and materials also lagging behind this week, along with big names in the technology sector. You can see utilities and real estate 3-month highs, and strongly bullish postures with rising moving averages. Healthcare also had a rising moving average. Of course, it's going to turn yellow with the close below today. And everything else, these are all ranked according to the updated sector selector rankings on our blog. So make sure you check that out. Brandon's proprietary tool that he's created to rank these sectors and how they're performing, where the relative strength is. You can see the weakness in the financial sector at a 3-month low, industrials pretty much at a 3-month low, materials retesting those lows, energy at a 3-month low on a closing basis, technology and discretionary not quite at the same lows, and you can see some relative strength in Staples. All of them bearish in terms of posture, but none of them down below 20, where you have that strong bearish posture. Even the S&P 500 still up above 50. So you see the weakest ones pretty much are communication services at 40, and then energy at 26. Everything right around 50, either a little bit above it or a little bit below it, with these other safe haven areas showing the relative strength. And that gets us to our trade idea of the day, and you can see with the S&P 500 being so bearish here down below the second standard deviation channel on its 1-year chart, there's going to be a lot of stocks that look very similar, and one of those stocks being Apple. You can see dropping down below its second standard deviation channel. If you take a look at its long-term chart, it's giving its death cross. You can see the 50-day crossing below the 200-day here this week at the close, and we talked about how that can set a low point here on a near-term basis as we make a run back up to the 200-day moving average there at 194. You take a look at some other indicators in terms of how extreme the selling has been for Apple. You take a look at we're above 40 on the DMI with a little bit lower high on the negative DMI, so a little bit of divergence developing there on that. You look at some other indicators like RSI, is developing a divergence as well. CCI, another common oscillator, also showing divergences really since the beginning of November on here at extreme levels on this. You take a look at something like the MACD, or excuse me, let's go to the Bollinger Bandwidth here to see again how extreme we are right now. The Bollinger Bandwidth is at a level above 30, and again, this is relative to the price. So if I were to show kind of a long-term view, you can see just how extreme that bandwidth has gotten. It's gotten up to a higher level than we've seen in the last 10 years. If you go all the way back over here, we haven't been above 30 on any of these lines. We did at the 2015. Let's see, I have to go back more, don't I? Is that 10 years there? and then go to a daily. Okay, so here it is, above 30 there, and you can see we have to go all the way back to the bear market recession to get the Bollinger Bandwidth getting higher than 30. So that's a pretty significant line. In fact, here, I'll show you here. Draw this horizontal line, and we'll set it at this peak that we had right at 31.6. So we'll edit that and put it at 31.6 here. So now I'll zoom out and show you again. That line is relative to where we've been before, and we haven't. The closest we've got was back over here on that rise to the upside, coming off of those lows in March of 2009. So this is extreme. This is extreme for the last 10 years, how wide the bands are. And usually that line will start to contract. And when the line contracts, we'll go sideways. At the worst, we'll go sideways, if not bounce back up at least to the 20-day moving average or up to the 200-day moving average because of the death cross. And then finally, you look at something like the MACD, which is not on a relative basis. It's on a absolute number here, but you can see too how significantly low it is relative to where we've been in the last 10 years. You can see the lowest peaks, the lowest low points around 4. Now that's when it was trading right around 100, but now as low as we've been here at 10, again shows the extreme moves and the big time divergence that we're setting up potentially with this new low point. So what can we do to trade that? Well, we can look at selling a put here in this 30 delta range. You get $430 on a naked put. For the margin requirement, you're getting a $2,500 margin requirement. So you're getting over 10% and around 15% return on this trade. Of course, to lose $2,500 if you were to analyze this. And here, let's get rid of the beta weighting and just look at the single symbol. And we will set our size to break even and change this to January the 19th. All right, so you can see for us to lose 2,300 or 2,500, it would have to really drop significantly down to 130. For us to lose 430, which would be our exit on this trade, it would have to drop to 150. So we're looking for a low point down into this area for us to get out at a loss similar to what we're trying to get for a gain. Alright, well that wraps us up for today. As always, thank you very much for watching. I want to hear from you now. Remember to comment down below in the YouTube section, a comment in our forums. I want to hear any comments or questions that you have, or any takes that you have there about what's going on in the market this week and what you expect next week, or anything that maybe I didn't cover today that you wanted my take on. You can do that there. As again, thank you very much for watching. Have a great rest of your weekend, everybody. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment. Follow me on Twitter for more content throughout the week, and join our community that we created on Facebook for the Market Outlook, as well as subscribe to our site at marketscholars.com. You can do that for free there. So again, have a great weekend, and we'll see you all next time.